Welcome to the Explainer. We're jumping right into the deep end today, moving way beyond the basics of regulatory capital. We're going to dissect exactly how this huge shift to explicit risk-based capital directly blows up product pricing models, puts a hard ceiling on growth, and frankly, forces companies to get incredibly sophisticated with how they manage capital to drive any kind of profit. So here's our game plan. We'll start with the real economic cost of just having to hold all this capital. Then we'll trace how that cost gets baked right into the price of every product you sell. From there, we'll look at capital as a very real constraint on growth, check out the toolkit for managing it, and then we'll wrap it all up with a big recap of the core ideas. All right, let's get into it. The first thing we have to nail down is this massive paradigm shift in how we even think about capital. You know, the move from it being this kind of hidden buffer to an explicit, real cost, that's the foundation for everything that follows in modern insurance finance. And this slide just lays it out perfectly. In the old world of implicit capital, you just embed these prudential margins, these PATs, directly into your liability calculations. It was all a bit blended, you know? But under modern regimes like Solvency II, that's all gone. Liabilities are now calculated on a pure best estimate basis, and your capital is a completely separate, explicit amount that you hold on top of that. It's there specifically to cover unexpected shocks. What this really does is force a completely transparent quantification of your risk. Now here's the kicker. This explicit capital isn't free, not by a long shot. Because it's locked up, stuck on the balance sheet just to ensure solvency, it carries a very real opportunity cost. We actually quantify this with what's called a cost of capital rate. Think of the 6% rate under Solvency II. This percentage is what shareholders demand as a return for putting up their capital to back these risks. It's the magic trick that turns a balance sheet number into a real, tangible cost on the P&L that absolutely has to be recovered. So, if you have this real quantified cost, how do you actually account for it? Well, insurers have a very precise mechanism for this, and it gets embedded directly into the pricing of every single product they sell. And here's how it's done. This process takes that abstract cost and turns it into concrete cash flows that you can plug into a profit testing model. Right at the start, at time zero, you model a big negative cash flow. This isn't just your sales commission. It includes setting up the full solvency capital requirement, or SCR, for that new policy. That initial hit directly impacts your net present value. Then, as the policy runs its course and the risk decreases, that required capital is slowly released, creating positive cash flows that you also discount back. That final release of capital when the contract ends is a massive piece of the overall profitability puzzle. This brings us, perfectly, to a classic exam question. This is the kind of thing they love to ask because it forces you to connect all these dots. How has this new world of explicit, risk-based capital totally changed the pricing game? The heart of the answer is this. Your pricing models now have to explicitly charge the policy for the capital it uses up. You've got two main ways to do this. First, you can model the capital cash flows directly, just like we saw, a big outflow at the start and inflows as it's released. Or you can just crank up the risk discount rate you use to value the future profits. A higher discount rate, as you know, lowers the present value of those profits. Mathematically, it has a very similar effect to that big upfront charge. At the end of the day, both methods are trying to do the same thing. Make sure the risk-adjusted return you get on that capital is higher than your company's hurdle rate. Okay, so this whole idea that every single product you sell eats up capital right at the beginning, this has massive implications for a company's big picture strategy. Capital stops being just a regulatory number and becomes a very real finite resource that actually limits your growth and your ambition. This is it. This is the central problem. Growth is not free anymore. Every new piece of business you write creates what we call capital strain. And that means you have to carve off a piece of your company's limited capital pool to back the new risk you just took on. Let's break down this new business strain with a quick example. So you get $100 in premium, which is great. But right away, cash flies out the door for commission and expenses. That's $80 gone. But then, and this is the key, we add another line item, the cost of capital. Now this $40 isn't a check you write. It's the risk-adjusted cost of having to set aside the required regulatory capital. And what's the result? You're actually at a net loss in year one, a strain of $20 that your existing capital base has to absorb for every single policy you sell. And that leads to a huge strategic consequence. A company's ability to grow isn't limited by how many customers want its products or how good its sales team is. It's limited by its available capital.
If you run out of capital to fund that new business strain, you have to stop selling, period. It doesn't matter how profitable that business might be down the road.
All right, let's chew on another exam question. How can being too good at selling more than you planned, actually become a massive problem? This question really forces you to face that direct, and sometimes pretty dangerous, link between your sales numbers and your capital consumption. Yeah, this is a classic double-edged sword. If your sales go through the roof and you blow way past your business plan, the total new business strain can drain your company's free capital way faster than anyone projected. This rapid burn can actually push your solvency ratio below the regulatory minimums or your own internal triggers. And suddenly you're in a crisis, and you have two bad options: slam the brakes on sales or go out and try to raise emergency capital, which is always expensive and often dilutive to your existing shareholders. So, given how critical and finite this resource is, how would you insurers actually manage it? Well, they've got a pretty sophisticated toolkit for this. So let's take a look at what they use. You can really think of these as the three pillars of modern capital management. First, you have asset liability management, ALM. That's your defense, your foundation. It's all about minimizing unrewarded risks, like interest rate mismatches. Then you have enterprise risk management, or ERM. This gives you that holistic 30,000-foot view of every risk in the company and lets you quantify diversification benefits. And finally, you have risk budgeting. This is your offense. It takes the output from ERM and uses it to strategically allocate your capital to the business units and the risks that are going to give you the biggest bang for your buck. And this is a great way to visualize risk budgeting. See, capital isn't just one big pot of money anymore. It's strategically sliced up. A company might look at its ERM framework and say, you know what, we're really good at underwriting risk. We have a competitive advantage there, and we have a bigger appetite for it. So they'll allocate a bigger chunk of their capital budget to that area. It's an active, data-driven decision to really optimize the company's entire risk-return profile. And this last exam question really ties it all together. It's asking about the ultimate value proposition of a complex framework like ERM. Is this just a compliance checkbox, or is it doing something more? At the end of the day, the real value of ERM is that it moves a company from just avoiding risk to strategically optimizing risk. By giving you that complete picture of your entire risk portfolio, it lets you actually quantify your diversification benefits. The fact that your market risk and your insurance risk aren't going to go bad at the exact same time. Understanding that allows for much more efficient capital allocation, which frees up resources to take on more of the right kind of strategic risks, the ones that actually enhance shareholder value. Okay, we've covered a ton of ground here, connecting a simple regulatory rule all the way to the core of a company's business strategy. So let's pull it all together, consolidate this entire chain of logic, and lock in the key definitions you absolutely need to know. And here it is, the entire story, the whole value chain, all on one slide. It flows perfectly from a regulatory change to a tangible cost to a pricing mechanism to a strategic constraint on growth, and finally, to the sophisticated management tools you need to optimize risk and return in this new world. That's the whole narrative. And finally, let's just hammer home these essential definitions. Think of these as your flashcards. Feel free to pause here if you need to, because having a crystal clear understanding of these terms is absolutely critical to showing that you've mastered this topic. And we'll leave you with this final thought to really ponder. Has this whole evolution of risk and capital management completely transformed what capital is? Has it gone from being just a boring compliance burden, a defensive shield, to becoming the primary offensive weapon for strategic advantage and creating real value?